I send out this homework email. I want to record a video showing you how to grab 10K filings from the SEC and calculate some ratios. Let's go to the new browser and let's search for Edgar SEC. It's going to take us to Edgar, which is the website where SEC makes all financial statements filed by publicly traded companies available to the public. I'm going to search by company, ticker. I'm going to search for Apple. Here, this is Apple's ticker. Here is Apple. And these are Apple's filings. Here I can see their annual reports and 10Q reports. I want to get the 10K report so that I don't have to add all the quarters, and I expect you to also get the 10K report. Let's open up the filing. We could see the filing in the HTML format. It also offers us this piece of interactive data. And there's an Excel document. So if I click on that, it downloads this big Excel sheet. And let me move that to the right window. Enable editing. We could see that it has lots of different sheets. Here's the cover page. It tells us that this is a 10K of Apple Inc. from California at One Apple Way, Cupertino, and so on, traded on NASDAQ and so on. Who do they have as an auditor? Ernst & Young, that's fine. Look, here is a consolidated statement of operations. That's income statement. Here are the top line, net sales, that's revenue, bottom line, net income. So we're going to need that. They give us another version of this is really footnote to income statement, which we're not going to need that. They give us a balance sheet. Here we have assets, liabilities, shareholder equity. That works fine. There's a parenthetical balance sheet. Here's the cash flow statement. Actually, for this exercise, we're not going to need a cash flow statement, but you could see there's a lot of different sheets here. Let's simplify things a little bit. Let's actually just move those two sheets that we need, which is the consolidated statement of operations, which is basically income statement. Let's copy that into a new book. I'll say okay to that. Let's go back to the financial report and let's take the balance sheet and let's also move that to that new book, which I think was called book 2. Okay, we'll say okay to that. And now we have a simpler, there it is, here's the book, here's book 2. We have a simpler Excel sheet with just 2 tabs, the balance sheet and the income statement. Let's create a new sheet here where we're going to calculate our ratios. And the ratios that I am particularly interested is the return on equity. And well, let's calculate that for what year? Well, we have we have their fiscal year ended in September 2022. So we're going to calculate it for fiscal year 2022. The balance sheet, yes, we've got the end of the fiscal year, beginning of the fiscal year. Fantastic. So let's calculate. This is all the numbers that are going to be for fiscal year 2022. Calculate return on equity means we need to take net income from 2022 and divide it by the average of two numbers, the average of total shareholder equity at the beginning of the year, comma, average, comma, and the shareholder equity at the end of the year. Close the parentheses, hit enter, and I have a 1.75, which is 175%. So Control Shift percent. So I'm going to format that as a percentage. So that's a pretty good return on equity. Probably Apple is a very profitable company. Let's see if I can validate that using, say, Wall Street Journal. Sure, let's go to search. I'm gonna look for Apple. There it is, Apple Inc. I'm gonna click on financials. Do they have a return on equity? Here's the profitability. Here are the different profitability measures. Return on equity, look, 175. Perfect. So we're right on the spot. We calculated it correctly. Let's calculate profit margin. Profit margin is going to be, let's take net income divided by revenue, just net sales. And that gives us 25%. Let's see, is that correct? Do they give us the gross margin? So that's just revenue minus COGS, but we want net margin. Look at that, 25%. So that's perfect. We're right on the spot. Let's calculate asset turnover. Turnover, and that's going to be what? That's going to be sales. So this number divided by average of assets. So I'm going to need to go to the balance sheet, total assets at the beginning of the year, and total assets at the end of the year gives me their asset turnover 1.1. Okay, so each dollar of assets generates $1.12 of sales. Very good. Let's calculate equity multiplier. Equity multiplier will take the average assets. So let's do average tab, and I'm going to do average assets from the beginning of the year and the end of the year. Close the parentheses, divided by average of shareholder equity at the beginning of the year, comma, end of the year. Close the parentheses, hit enter. Now I have equity multiplier of 6. So it's a pretty high equity multiplier. Essentially, basically $6 of assets are financed using $5 of debt and just $1 of equity. So this is a pretty high leverage. And profit margin, asset turnover, and equity multiplier make up our DuPont formula. So let's verify that we indeed are going to get ROE if we take the product of these guys, profit margin, asset turnover, and equity multiplier, and we should get 1.75. It's formatted as a percentage, and that's what we get. So the DuPont formula holds, and that's what I wanted you to do. And we validated the ROE and the profit margin using Wall Street Journal numbers. Here, total asset turnover 1.12. Is that what we got? Yeah, we got exactly the same thing. let's see, do they report anything else? That's in the DuPont formula, no, but we clearly did a good job. We validated our ROE in the DuPont formula holds. So this is what I would like you to do for your companies. And every company may report the financial statements slightly differently. So you'll have to look for the right numbers, validate them against Wall Street Journal or Seeking Alpha or Bloomberg, whatever is your preferred source of financial information. I'm just going to stop here.